So before we can actually get started, I'm just going to dive into a couple of housekeeping notes so the webinar can run as smoothly as possible. Please feel free to ask any questions you want throughout the webinar. There's a Q&A box at the bottom of your Zoom screen. So please pop your questions in there. We'll be saving time at the end for questions. And thanks to everyone that submitted their questions ahead of the webinar. We will be answering them today. The session will be recorded and the recording will be sent to you via email. Today's webinar will be delivered by Elliptic's Chris DePau, Senior Advisor of Financial Institution Regulation and Compliance. Unfortunately, our product manager, Alex Kowinski, has been hit with COVID and will not be able to join us today. So we are sending her lots of well wishes. But if you do have any technical product questions, please do pop them in the chat. If we can't answer them today, we will forward them onto our superstar product team and get back to you. The webinar will be approximately 45 minutes, so you should get some time back at the end. I'm sure it's a very busy time of year for everyone and we'd all like a couple of minutes back. And that's about it for housekeeping. I will hand you over to our host to introduce himself properly and to get us started. Thank you, and over to you, Chris.
Thank you very much, Sasha. Appreciate it, and great to be with everybody today. My name is Chris DePau. I'm the Senior Advisor for Financial Institution Regulation and Compliance here at Elliptic. What that means in short is that I help our customers to develop crypto-specific AML programs, integrate them into their existing compliance frameworks. We also do a lot of outbound content and thought leadership marketing, as well as working with customers on the development of internal policies and procedures. In my past life, I was a compliance officer at a large financial institution. I'm very familiar with a lot of the pain points that the folks on this call deal with on a daily basis. And certainly after the presentation, if there are any follow-up calls, any questions about anything we've discussed today, please feel free, as Sasha said, to either put them in the chat box or to message us directly. We're always available to discuss. And so just want to talk a bit about the conversation today and where we'll be heading. We're going to start off with a brief overview of sort of the rules of the road, where the regulatory landscape in the United States stands today, what some of the changes coming out of the updated FATF guidance are, and how they might impact the application of a due diligence program to VASP customers for financial institutions, crypto native companies, and other types of entities. We're going to cover both counterparty and customer due diligence. We're going to really handle it as one standard overview of due diligence. We're not going to sort of break things down specifically to talk about customers versus counterparties. The risk assessment is largely the same when determining where there are sort of financial crime risks, where there's overall regulatory risk, things like that. That said, there are some nuances between the two. Typically, the regulatory regimes globally, but specifically in the United States, have a stronger hand when it comes to customer due diligence. So that will largely be where the focus sits. When it comes to counterparties, we're more talking about taking due diligence on a risk-based approach and worrying more about reputational risk and things like that than we are direct regulatory considerations. Although that is not universally true, there are certainly situations in which there are hard regulatory obligations related to counterparties as well. After having a chance to sort of briefly discuss those topics, we're going to go into an overview of Elliptic's Discovery product. That's our VASP due diligence tool. We'll give an overview of how that works, how it can be of use to your organization, and why it stands apart from other products in the industry as a best-in-class solution for performing VASP due diligence. Lastly, we'll do a brief summary of what we've discussed, talk about sort of the future of the regulatory landscape, and then have a conversation about where we go from here. And then we'll take any questions that anyone in the audience might have. So just to kick things off, I want to talk briefly about the rules of the road. So there are regulations that are implemented at the national level, and those are the actual regulatory guideposts that have to be followed from a compliance perspective. Oftentimes, those national level regulations flow down from a supranational organization, coordinating between different national regulators to come up with what should be a global compliance program that's applicable to virtual asset service providers. And that coordination is done through the Financial Action Task Force, FATF. A lot of the folks here may be familiar with FATF already. For those who aren't, just to give a high-level overview, it's important to understand that FATF is not itself a regulator. It's, as I said, a supranational organization that makes suggestions and the FATF recommendations that then are typically implemented by jurisdictions that have adequate compliance controls in order to create regulations that are similar worldwide, but that can be specifically tailored for the needs of a given jurisdiction. And that's important because there can be quite a bit of nuance that comes up between sort of the same standard being implemented in somewhat different ways in various jurisdictions. And we'll get into a bit more about that and regulatory arbitrage strategies that some companies in this space seek to employ as well, and how we can combat that and ensure that all of the actors within the crypto ecosystem are living up to the standards that FATF sets, and more importantly, that local regulators mandate. So just to sort of set the table, I want to go over a few basic definitional points first. And we're going to get into this section right here on what a VASP is. But just so everyone understands, because I know we have a bit of a mixed audience here when it comes to understanding of crypto as a whole, we're going to be using some specific terms to refer to different types of cryptocurrencies and other virtual assets. Specifically, we're going to be talking about stablecoins a bit. So for those who are not aware, a stablecoin is a virtual asset that is pegged against another asset, very often the US dollar. That's certainly the most common type. And stablecoins can be created either through direct asset backing, meaning that there are actual reserves held, whatever the pegged asset is, to maintain the stability of a coin. For instance, a stablecoin that is pegged to the US dollar may be backed on a one-to-one basis by US dollars held by some custodian entity, could be a bank, could be certain other types of financial institution as well. And then there are algorithmic stablecoins. Algorithmic stablecoins operate in a different way. They do not rely on actual direct reserve backing. Instead, they're issued through a DeFi debt protocol in which an individual can basically post collateral within the protocol itself and then receive a loan denominated in the stable coin, and it maintains stability in that way. We won't get too into the weeds on exactly how that works, but it's something to keep in mind. And certainly if anyone does have any more specific questions on how that functions, we can handle those either offline or at the end. We'll also be talking about governance tokens a bit. A governance token is a token that is used to basically vote on changes or policies related to a DeFi protocol. Token holders typically, though not always, get a one-to-one vote based on the number of tokens that they hold. And that can be used to make changes in a protocol, can be used to organize fee structures, things like that. And we'll talk about that briefly later as well. And speaking of that, DeFi as a general concept is something that you will need to be aware of as we go through these definitions. DeFi stands for decentralized finance. Decentralized finance is a interconnected system of protocols that operate automatically, algorithmically, often managed through something called a decentralized autonomous organization, which is not a legal entity, which provides some significant due diligence challenges. And we'll get into those and issues of control as well throughout the presentation. But it's just important to keep that in mind, that these are basically financial constructs that allow you to engage in different types of crypto-based financial transactions without any third-party centralized intermediation, and that are not typically controlled by a centralized third-party entity, although that is possible in some cases as well. And just a brief note on what the sort of regulatory regime that is applicable here is. So within the United States, any virtual asset service provider is also a money services business. They have to be registered with FinCEN, meaning that there is a requirement for an adequate AML program to be implemented. There is a huge outstanding question right now as to what types of entities qualify as virtual asset service providers, and we'll talk about that in brief. But it's just key to know that these requirements are, from a regulatory perspective, not being purely taken on a risk-based approach, that these are MSBs and they have to follow AML regulations as implemented in the United States. So to step back a bit, we're going to talk a bit about what a VASP actually is. So in the original guidance that was published by FATF, these are the 5 criteria used to determine whether or not a VASP might exist. And that's whether there is a facilitation of exchange between virtual assets and fiat currencies. So for instance, facilitating the exchange of Bitcoin to US dollars, an exchange between one or more forms of virtual asset. So facilitating the exchange of, let's say, Ethereum to Bitcoin, a transfer of virtual assets, and you'll see a superscript 1 there. Transfer of virtual assets in this instance means on behalf of a third party. So it's not merely that you're sending your virtual assets to a friend, to a merchant that you might be paying, but instead we're actually talking about facilitating the transfer of virtual assets on behalf of some third party, typically for a commercial purpose. The safekeeping or administration of virtual assets or enabling control over virtual assets is also brought into scope. Things like custodial activities. Obviously, there need to be strong controls implemented when you're maintaining control of virtual assets on behalf of another person. And then lastly, participation in and provision of financial services related to an issuer's offer or sale of a virtual asset. So very similar to what an investment bank might do in the securities world, in the traditional finance world. If you're facilitating an initial coin offering or you're otherwise providing financial services related directly to the virtual asset. So to be clear, that's not to say providing financial services sort of not attendant to the virtual asset issuance. So if you're handling proprietary flows for an issuer, if you're doing work not directly related to the issuance of the coin, you will likely not be brought into scope. But if you're actually facilitating the issuance of the coin itself, that will bring you into scope as a virtual asset service provider. This definition was modified very recently in October 2021. FATF published updated guidance that spoke specifically, it spoke to many things, but specifically it spoke to the DeFi world and where there might be a VASP within the DeFi world. So one of the challenges that I discussed a bit earlier is the fact that in the world of DeFi, there is often not an actual legal entity responsible for the maintenance and implementation of the protocol. That's not always true. There are some actual legal entities that have started as businesses who seek to sort of implement adequate compliance controls and launch a DeFi environment of some sort. But more often than not, it's sort of a disparate group of individuals who maintain the protocol either as hobbyists or because they have some pecuniary interest. They may be the holders, for instance, of those governance tokens that we discussed earlier, and they may want to see them rise in value. And so they help to promote and maintain the ecosystem. The recent FATF guidance was clear that even when there is not a legal entity that may directly be considered to be a VASP, it's very likely that there is some promoter or third party that maintains control or sufficient influence. And that's really the key phrase that we're going to hone in on here: control or sufficient influence in a DeFi arrangement so as to make them a VASP. And this can be problematic in several regards. One, it may not be a legal entity at all. It may be, a few folks in their basement, right, that are maintaining the protocol that don't, act in any sort of centralized or coordinated way other than all having an interest in the maintenance of the protocol. There may be anonymous actors involved. In fact, there are often anonymous actors involved in this type of organization. And that's because, there is no sort of registration requirement. It's really just once it's brought into creation and the sort of maintenance process begins and pseudo financial transactions can be engaged in, the regulatory obligation emerges from that. And so unless you're addressing those regulatory obligations as they spring up, it's likely that a DeFi protocol implementer or operator may not meet those regulatory requirements. And that can be particularly important when the underlying sponsor of a protocol may be brought into a financial institution as a potential customer, even unrelated to customer flows. So for instance, if there is a decentralized exchange that has some sort of attendant organization or operating entity, that operating entity may seek to receive venture capital funds, for instance. If they do that, those funds will have to sit somewhere within a bank account, and there needs to be a risk assessment done to say, okay, are we comfortable taking these proprietary only flows into our organization, understanding that there's no sort of direct vicarious customer risk when we know the type of activity they support? And that's where conducting a fulsome VASP due diligence process becomes extremely important, because only by assessing those risks and determining whether or not they fit within your organization's particular thresholds can you make a well-informed decision as to whether this is a customer type that might be onboarded or not. Just a few of the major takeaways from the FATF update. So the definition was modified to include controllers of DeFi protocols, as we just discussed. It excludes specifically those who merely provide ancillary infrastructure services, such as verifying accuracy of signatures. So we're not trying to scope in every software provider, third-party service provider, attendant entities that might only help to implement controls or other sort of technical support for the protocol. There was a strong emphasis placed on the travel rule, and lots of folks from the traditional finance world are likely familiar with the travel rule. But just as a brief overview, it requires originator and beneficiary information be transmitted and verified whenever there is a virtual asset transaction between two virtual asset service providers, two non-virtual asset service provider financial institutions, or between a non-virtual asset service provider financial institution and a virtual asset service provider. That's a long way of saying it's really focused on institutional transfers. So if you happen to have an unhosted wallet, that is a software wallet that you just create yourself, and you send a transaction to another individual in the same circumstances, you will not run into a travel rule obligation. This is focused very much on regulated entities and transactions between them. And that actually gets to the next bullet point, which is that unhosted wallets are excluded. So we're not trying to get sort of, mom and pop retail investors just transferring blockchain assets between each other. Those are not being scoped in here. One thing that's very interesting that I think surprised some people, although maybe not those who are really keyed into the industry, is that NFTs are not considered to be virtual assets. There's been quite a hullabaloo around risks related to NFTs recently, particularly given sort of the large opportunity for money laundering present not only in NFTs, but in the art market more generally. The FATF guidance made clear that because of the non-fungible nature of these assets, and because of the fact that they're not often used as financial instruments in quite the same way as a standard cryptocurrency virtual asset might be, that they should not be included here. That's not to say that there aren't sort of digital asset related controls concerns and compliance obligations that might run along with them. It's just that this specific guidance related to AML program implementation for virtual assets is not directly applicable here. And lastly, stablecoins, which you've already touched on a bit, were really highlighted, and it was made very obvious that those are it's a focus area for regulators and should be a focus area for compliance professionals as well. Particularly when it comes to non-algorithmic or asset-backed stablecoins. It's very important to ensure that the asset backing claimed to underpin the stability of those coins actually exists, and that can be done through information sharing processes, audited financials, and similar means. But we've seen several regulatory actions already in the past directly related to this area. And it's important as we go forward to make sure that these stable coins actually do have the backing that they claim, because if you were to see a stable coin theoretically pegged against the dollar drop to 50 cents, it would shatter faith in the ecosystem in which that coin operates and could have knock-on effects based on, sort of the interoperability between that stable coin and other virtual assets that could have a large price impact across the industry. So really focusing in on stable coins, not only through the FATF guidance, but also updated guidance coming out of the SEC recently as well. And so we'll get into the meat of the discussion now. This is about counterparty and customer due diligence. And so from a very high level, there are some basic expectations and obligations that all virtual asset service providers should meet, and that when conducting due diligence on a virtual asset service provider should be inquired about by a financial institution or other entity seeking to engage with them. You may be familiar with these from the traditional fiat world. These are very much similar to the 5 pillars of an adequate AML program. And if you were evaluating a financial institution customer, you would, that is AML regulated, you would seek to ensure that the 5 pillars are appropriately implemented. Here within the crypto world, there's a very similar obligation, although the ways in which they're implemented and the exact requirements vary slightly from the fiat world. The first and arguably most important is that you have to maintain adequate policies and procedures related to AML and KYC tailored specifically toward virtual assets. What does that mean? Well, first, you want to ensure that the virtual asset service provider that you're engaging with itself conducts adequate due diligence on its customers, because that vicarious risk that flows from your customer's customer is often sort of the most pernicious problem that an entity might face when exploring this space. And I don't think that's any secret to folks who maybe have experience with correspondent banking or similar financial arrangements. It's often nested activity that you may not be aware of, although you should be aware of, frankly, that can cause the most problems. And that's true within the crypto ecosystem as well. So if there is, for instance, a virtual asset exchange that's seeking to look for a partner in facilitating on-ramps and off-ramps of fiat funds, you want to ensure that that exchange is applying appropriate controls to their customers so that you don't have some sanctioned party or maybe someone who poses a reputational risk, someone that's been involved in a dark web marketplace interaction, something like that. You want to make sure that you are not facilitating a fiat exchange for them, and you're going to have to rely on your counterparty or customer in the exchange world in order to do that. In addition to just looking at sort of direct risk, you should ensure that these individuals or entities are conducting adequate due diligence when it comes to the actual coins or other virtual assets that they facilitate transactions with. So whether it be a custodian, an exchange, or any other type of virtual asset service provider, they should be ensuring that the coins or tokens that they work with don't represent a security, or if they do represent a security, that the risk is appropriately mitigated and that all appropriate financial disclosures have been made. This is not yet something we've seen as far as tokenized securities go. It's something that's certainly, a hot topic, and we do expect to see movement in this space in the relatively near future. But for right now, it's, if a token is deemed to be a security, it should likely not be engaged with by a virtual asset or virtual asset service provider. And there have been several notable cases recently, and without naming specifics, we can certainly take a look at entities that have been said by the SEC or other regulatory agencies to potentially represent a security issuer, and their coins may represent a security. We've seen exchanges delist them or freeze holdings in those assets. And so it's very important to do a securities analysis, leveraging both Howey and Reeves tests before determining whether or not you might, or your customer might engage with a particular virtual asset. There then comes the question of whether they support activity related to privacy coins. For those folks not aware, largely speaking, the cryptocurrency ecosystem is only pseudo-anonymous. So it's a bit of a misnomer that cryptocurrency is anonymous. It's not. You can see wallet addresses and you can see transaction hashes that can give you a very good idea of, if not the underlying identities of people involved in transactions, then the sort of digital identities of individuals or entities involved in transactions. That's not the case with privacy coins. With privacy coins, the blockchain is obfuscated through encryption, and so it's very difficult to conduct any type of monitoring or analytics on those coins, or to accurately look at the transactions being engaged in and determine how risky they are, because it's simply not visible to outside actors. So if you are providing services to an entity that either facilitates exchange with privacy coins or custodies privacy coins, similar activities, then there does need to be an additional sort of risk scoring nuance that comes into play, and risk points have to be added appropriately for that activity. It may be the case that you don't want to engage with any entity facilitating that type of activity at all. It is somewhat important to note that when it comes to privacy coins, there are different types. Certain privacy coins like Zcash, which some folks may be familiar with, allow for transactions to be both shielded and unshielded, meaning that you can disable the privacy enhancing features of those coins, making them less risky. And there are others like Monero, where everything is private by default and where that risk cannot be appropriately mitigated through on-chain technology. Then also, when looking at the types of coins that they engage with, we should be looking as to whether or not they engage with stable coins as well. We discussed stable coins a bit already, but it is another part of the assessment. And if you are going to facilitate activity with an entity that issues or custodies stable coins, please be sure to ensure that if they are actually asset-backed, those assets truly exist in the way they claim to be, and that there hasn't been any sort of major regulatory action that might undercut sort of the appropriateness of the compliance program of the issuer. Next step in the process here is requiring ongoing training of personnel related to virtual asset service providers and virtual asset compliance. And so it's important here to not only focus on the traditional AML typologies within the fiat world, but also to look at sort of the unique risks present within the virtual asset world. So training folks to look for instances of potential ransomware attacks, training people to be aware of hacking and DeFi protocol risks, things like that are a bit outside of the world of traditional fiat AML and transaction monitoring, but that fit very much into the world of virtual asset compliance. Next, you should designate an adequate AML officer. Seems a bit pro forma, but it is important that this individual who is the AML officer is familiar with both fiat and virtual asset compliance. And that's because there's often a lot of overlap. And so you want an industry expert who has experience in both areas so that you're not going to sort of miss regulatory obligations in one versus the other. And when onboarding a potential customer who is a virtual asset service provider, understanding the upper management of their compliance team and of their operations team is really important to ensure that you have trust in the controls that are being implemented and in the people who are managing those systems. Next, you need to conduct ongoing due diligence reviews of your customers, meaning that your customer needs to conduct ongoing reviews of their customers. This should include looking at geographic risk of their customers. This should include looking at the transaction history of those customers. Do the expected flows that your customer sort of suggested they would have at onboarding, do those match what you've actually seen? Are the values and volumes of those flows maintained in an appropriate way in line with what they claimed they would be at onboarding? In addition to that, you can also look at things like political exposure. You can look at reputational risk, negative media. All those types of reviews should be done by virtual asset service providers on their customers to ensure that none of that risk flows into your organization when working with that virtual asset service provider as either a customer or counterparty. Lastly, you need to implement an internal and external compliance audit program. I think everybody knows that what's written in policy and what happens on the ground within an organization can sometimes be different. And so it's very important to take a look at these actual compliance operations and to ensure that the standards that have been set at a policy level or even at a regulatory and legal level are actually being met on the ground. Just to talk a bit more about these expectations and to get into a few specific use cases here. When working with an exchange, financial institutions and other organizations have to understand that nested risk that we spoke to. And in order to do that, you're going to have to sort of peer through the blockchain activity using analytics tools. And we'll certainly get into a bit more on how you can do that later in the presentation, but you need to actually look at the activity and look at the movement of funds through different actors to tell whether or not you may be dealing with a situation where you have sort of a pseudo money mule moving funds on behalf of another person, whether or not there's an intent to obfuscate the history of transactions, et cetera. When you're looking at miners, another very hot topic in the industry, you have to ensure that not only do they have a strong compliance program in place, but they've really thought out potential sanctions risk. So OFAC has released some guidance on sanctions risk in the virtual asset space. They were somewhat silent, though, on miner specific risk, and that risk can arise in sort of two different ways. You can either have a miner that could potentially be confirming cryptocurrency transactions for a sanctioned party, or you can have a miner operating in a sanctioned jurisdiction or by a sanctioned party. Both of those present certain risks. The first is less risky than the second, in that we know that it's likely these transactions take place today, and we've yet to see any regulatory actions in that regard. But that's not to say that they couldn't happen in the future. And sanctions is something that's always sort of front of mind for regulators when looking to examine a particular entity. Lastly, here for our continued expectations and obligations, if you're holding proprietary funds for a DeFi protocol, so as we discussed earlier, holding funds maybe for venture capital purposes, et cetera, you should ensure that any controlling parties have been identified and have implemented an AML program where required. And the challenging part here is knowing who those individuals who may be responsible for implementing an AML program within the DeFi landscape are. Governance token holders, individuals who own a large number of governance tokens, may in fact be scoped into that definition. That is still very much unclear. We're sort of waiting for regulatory guidance on that and working with our regulatory partners to better understand that. Likewise, individuals who have a significant financial interest or ongoing business relationship with the protocol might also be brought into scope. We've sort of spitballed a few potential ways that this type of standard could be implemented. You might borrow from the CDD rule, the beneficial ownership rule that folks might be familiar with, where if, for instance, a given entity or individual owns 25% or more of the governance tokens of a particular protocol, perhaps that entity or individual should be brought into scope as a VASP. It's still sort of the Wild West when it comes to that type of regulation. So as more information comes out, certainly we'll update our guidance there, but it's a key area to keep an eye on for the future. So knowing your customer in the virtual asset world. So your KYC policy has to address the unique risks presented by the virtual asset sector. Sort of chief among those is the pseudo-anonymous nature that we already discussed of virtual assets. So even if you do have, for instance, the wallet addresses between parties who are engaged with each other, it's important to know the actual name, date of birth, physical address, et cetera, of those individuals who are engaging those transactions, so you can adequately mitigate the risk that they might pose. And you're not just dealing with a set of numbers, you're actually dealing with people that you know. That information is the CIP information that has to be collected and verified in line with standard expectations outside of the virtual asset world. Very important information related to specific geographic risk also needs to be looked at. Local due diligence. There are lots of different standards as to not only the risk posed by individuals from certain countries, but the regulations applicable in those countries that may or may not prohibit or allow certain activities. So you can look at sort of the difference between a country like El Salvador that has fully embraced Bitcoin, is making it legal tender, is very much engaged with the development of the cryptocurrency sector, versus a country like China that has more or less outright banned cryptocurrency interactions and has a much higher standard for what might be appropriate activity in that jurisdiction. Lastly, identifying the true underlying owner of a VASP can be problematic. This is because historically folks in the crypto industry have been privacy advocates. There is a large movement still existing within the crypto ecosystem to ensure that privacy is sort of the main issue focused on by developers. That's not necessarily a bad thing. Privacy rights are extremely important. Likewise, though, it is important to identify the people that are controlling this protocol to ensure that it's purely privacy that they're seeking to sort of create or promote through these mechanisms, and they're not engaging in privacy-based transactions in order to hide bad activity. So outside of sort of the direct regulatory risk, there is on-chain risk as well, blockchain-based risk. And this comes from activity that a given customer might engage in on the blockchain itself. So it's important to note that the vast majority of blockchain-based transactions cannot be stopped. So if I have a wallet containing virtual assets and I want to send you some of those virtual assets, and I have your address, and I hit my send button within my wallet, it is likely going to be impossible for you to reject those funds. That said, even though it may not be a bad actor that is receiving funds from a problematic party, if there is a propensity for lots of these funds to be sent to a single party, it's likely there is some association. There might be an underlying bad actor who is ultimately leveraging a given virtual asset service provider for nefarious means. So if you're a financial institution, you should definitely need to identify whether your customer or counterparty allows for engagement with any dark web marketplaces. So for those not familiar, the dark web is a non-searchable layer of the internet that can be accessed through certain browsers that allows for transactions in things like drugs and child abuse material and all sorts of horrible things. If a given virtual asset service provider has a history of allowing transactions with these types of entities, that should at the bare minimum be flagged. And in all likelihood, there may be a risk exit associated with that type of activity if it occurs on an ongoing basis. Similarly, if they've been found to violate sanctions controls repeatedly, again, not incidentally, and assuming that those risks have not been adequately mitigated, there may be cause to terminate a relationship or to apply additional risk points. If there has been any activity from an illicit source that's flown into or out of a given virtual asset service provider, that might be indicative of lax compliance controls as well. So you may have seen ransomware hacks that have occurred in the recent past. Ultimately, the goal of those ransomware attacks is not to receive virtual assets and just hold on to them forever. It's to receive virtual assets and then exchange them for fiat dollars. And that has to occur through some type of virtual asset service provider, most often in an exchange. If you note an exchange that has, again, a propensity to facilitate that type of activity, it's likely that you should reconsider the relationship or apply appropriate controls where applicable to reduce the risk. And lastly, if they're facilitating transactions to or from a terrorist, extremist, or other undesirable organization, certainly there should be an immediate cessation of activity with that party and a review of the customer relationship. Terrorist financing is something that is very much a hot topic in the cryptocurrency industry right now. One way that can be mitigated is by leveraging a partner such as Elliptic in order to conduct adequate blockchain monitoring to ensure that your transactions are not, or that your customers' transactions, are not involved with any type of terrorist or extremist organization. So there are a lot of problems that are faced from an operational perspective when trying to conduct VASP due diligence. One of the biggest problems is information paucity. There are a ton of moving parts within a compliance organization. Entities within the virtual asset space are often not super well organized, and their organizational structures can be very difficult to follow. And there's a problem with ensuring that all information is known by all parties when applying a due diligence program. So just to look at this model here, typically what we'll see is a front office salesperson will come in with a deal, related to a virtual asset service provider. And then there are all these other parties that are involved with the decision and the onboarding process. Compliance operation and onboarding will be responsible for sort of doing the actual physical work of inputting the information and verifying it. A compliance advisory team may be sought for an opinion as to whether a particular activity is appropriate or not. Legal will then likely chime in as well to say whether or not a given piece of policy implemented by the advisory team meets legal and regulatory expectations. And then the QA and QC functions will vet whether policies have been followed appropriately. Throughout those steps, there are multiple opportunities for information to become convoluted or for the entire picture and the risk profile of a customer to not be understood entirely well. And it is important then to have a tool that allows for all that information to be placed in a single location, to be accessed by everybody, so that sort of all chips are on the table as to what the total risk presented by a particular organization or legal entity might be. And that gets into the actual Elliptic Discovery product, which I'll talk about briefly here, but again, we can certainly go into in more detail offline. But just as an overview, Elliptic Discovery is a tool that allows you to assess VASP risk based on several factors noted in the VASP. So you can detect your exposure to VASP through your customers, and you can understand and assess the risks with a VASP as a customer as well. So two separate use cases, both important when trying to mitigate financial crime. Within Discovery, there are profiles that contain information on the legal entity, registration details, locations, et cetera. This is a great tool for sort of out-bucketing potential customers. So if you have a given virtual asset service provider that comes to you, and you know that based on Elliptic's profile of them, they represent an extremely high risk, you may be able to say automatically, we're not going to waste our operations team's time in attempting to conduct this onboarding, because we can see based on this risk scoring methodology that it sits outside of our risk tolerance thresholds. The system also provides information related to currency support, both fiat currency support, and also whether or not they engage in any type of privacy transactions, provides information on their KYC program, takes a look at their AML policy where applicable, and also gets into the licensing and registration information of these entities. One interesting note here is the legal entity name portion. So something we found is that it's very, very common for virtual asset service providers to have a different operating name than an actual legal entity name. So if you're conducting, for instance, CIP verification, you need to verify independently the legal entity name of a customer, it can be challenging to find through a non-documentary source. We provide that here within Elliptic Discovery, and it's a great solution when trying to conduct that verification process. Additionally, we also look at the blockchain activity attendant to a particular virtual asset service provider. This is really our bread and butter. And it helps us to look at whether or not the blockchain transactions related to a particular virtual asset service provider are problematic to your organization or not. So we can look at anonymizing volumes, the volume of activity that is attempting to obfuscate the history of a transaction, illicit volumes, transaction with sanctioned entities, and things like gambling volumes. Gambling is an interesting one. In the US, it is a highly regulated industry with lots of attendant financial crime concerns. In the UK, for instance, it's still very much a regulated industry, but it's not prohibited in such a way. And so there may be a different risk appetite for some of this activity, depending on exactly what jurisdiction you're operating in. And so in order to give a view of what the overall risk of a customer looks like, Elliptic assigns a score based on all of these factors amalgamated together. And that score is between 0 and 100. That sort of indicates the overall risk of an attendant customer. It's the transactional, operational, compliance score all blended together. And again, this is where that out-bucketing functionality really comes into play. Because even if there is very little operational risk, for instance, if you're seeing a tremendous amount of transactional risk and you're seeing lots of transactions coming in from a dark web marketplace, even if it looks from the outside like this is a very buttoned up organization, there's likely still a lot of risk right below the surface that's hidden within the blockchain, which is something that Elliptic can help expose. And this is just an example of what a risk profile score for a given customer might look like. To give you an idea of what these scores look like, the top quartile of our VASPs that have been assessed through this tool have roughly a 16 score out of 100. The median is a 32, and the bottom quartile have around a 43. So it's only the most extreme examples where you're getting this tail of a very high risk score. Oftentimes, these are operating in non-compliant jurisdictions. They have very lax AML and KYC controls, and they may have an association with some known bad actor, which is why you see the majority of entities sort of in this distribution here with the median score of a 32. So we've gone over a bit of how we conduct blockchain how we conduct blockchain due diligence for counterparties and customers, what the basic standards are for these counterparties and customers. The question now is, where do we go from here? Regulatory oversight is not going anywhere. It's only going to expand. And that is a very, very good thing, in my opinion. By increasing regulatory scrutiny and forcing the implementation of stronger compliance controls, you're going to draw in institutional investors and retail investors, because folks that are managing money on behalf of others, along, sort of ironically with very small investors, are both very much interested in ensuring that they are not paired against any type of problematic counterparty, and that their funds are safe, and that they're not sort of facilitating any type of criminal activity, because ultimately, that's a reputational stain on the industry and might have a negative price impact on the assets being held. So through the expansion of compliance functionality, I think we're going to see an increase in mass adoption of cryptocurrencies. Likely a safer ecosystem will develop from that, and we'll continue to see a ton of engagement from regulators and private sector partners in that space. The standards of beneficial ownership in the DeFi space will continue to evolve as well. We discussed whether or not, for instance, governance tokens might be used to determine a beneficial owner, whether or not associated developers could eventually be scoped into the definition of a beneficial owner, although all sort of information we're seeing on that point so far points to no in that regard, but it's still very much unsettled. And we're going to have to, over time, make a determination as to who the appropriate person to deem a controller or owner in that sector is. Guidance related to risk scoring methodologies is already emerging. So there are industry best practices that have been formed now to look at a blockchain monitoring and analytics tool like those that Elliptic provides, and determine whether, based on the results of those tools, it might be sensible to apply risk points or to risk exit a given customer. Traditional market style regulations are also very likely to be imposed on the virtual asset industry. And so we talked at the very beginning about how in the virtual asset space, there are sort of requirements related to the fiat world that are drawn from the fiat world, but aren't direct parallels. This is one of the areas where that's a big problem right now. For instance, there are not really regulations around non-security, non-commodity pump and dump schemes, insider trading events, things like that. If we're going to see the market truly flourish and we're going to see the type of institutional adoption that we'd like to, then these types of controls are going to have to be implemented. And when your organization is conducting due diligence on a virtual asset service provider, you should look to see that they're already starting to think about these things and implementing controls on a risk-based approach, because frankly, it's bad for the entire industry if market manipulation is allowed to proliferate without any kind of backstop. Local regulatory initiatives are going to expand or constrain the market, again, with the El Salvador versus China example. I do think that in the US and in Western Europe, we're very likely to see a regulatory approach that seeks to promote innovation. I don't think we're going to see any outright bans, but at the same time, there will be increased scrutiny, examinations, et cetera, of virtual asset service providers. And so those entities conducting due diligence on them should ask for the results of those exams and any findings by regulators. Sometimes they're able to share, sometimes they're not. Either way, it should give a better idea of exactly where they sit and what the challenges from a regulatory perspective that they might face are. And then lastly, greater integration with the traditional financial services industry is going to bring more scrutiny, but it's also a huge opportunity. Crypto enthusiasts, in the past were the main customer segment here. As we start to see large money services businesses, banks, custodians, other traditional financial services entities enter the space, we're going to see an explosion of growth, and we're seeing that now. And what that means is that due diligence and preparedness in order to address the risks that arise within this space are going to to be of paramount importance. You cannot onboard a virtual asset service provider without conducting a very thorough due diligence program and analysis, and that can't be conducted without having some type of tool that gives an overview of the blockchain associated risk of that particular entity. That's where Discovery comes in super handy. It's an outstanding tool to help conduct those risk assessments, and we're here to partner with you in implementing it or to address any questions you might have related to virtual asset service provider regulatory issues. Now we can open things up for questions, and I'll hand back over to Sasha. Thank you.
Thank you, Chris. That was a super informative and interesting session. We have quite a few questions already to get through, so I might get started straight away. And if you have any lingering questions, remember to pop them in now while we can still answer them. So our first question was, what is the biggest risk that a large organization face when considering onboarding a VASP?
Yeah, I think it's the unknown activity. It's the fact that, and again, similar to the correspondent banking world, lots of activity or lots of risk related to virtual asset service providers comes from your customer's customer. So it's that reliance factor, and having to sort of ensure that your customer, your virtual asset service provider customer, is looking at their customers in an adequate way and is assessing that risk. Now, on chain, that's one thing. Elliptic can be extremely helpful in conducting that type of analysis, because we can look at all the blockchain movements associated with that virtual asset service provider, particularly funds coming in that could potentially be problematic. Off-chain, it's a larger challenge because you're still relying on sort of paper data in order to understand the overall risk profile of an entity, where they operate, how they operate, et cetera, and whether the customers in those different locations have been subjected to the same standard of due diligence. So definitely get copies of policies and procedures and analyze them. You should demand them from any of your virtual asset service provider customers. If they won't provide them, I would see that as an immediate red flag. And when doing that type of analysis, ensure that they're not only addressing individual risks related to the virtual asset activity in the US, but also anywhere else that they may have a customer.
Thank you. And next question, what if NFTs get pegged to asset backing, for example, can also be used as collateral for other transfers?
Yeah, they're still not going to be virtual assets, but I think it's important to sort of separate the discussion of whether or not an NFT is a virtual asset, versus whether it might represent some other type of financial instrument. So if you have an NFT being used for collateralization purposes, for instance, it will be subject to the same credit style regulations within a financial institution that any other collateral posted might be. Within DeFi protocols, that's obviously still an evolving space, and there have not been outstanding compliance controls yet implemented. And we speak about this briefly in the DeFi report that we recently released as well, but that is changing, and we are seeing more direct engagement with the sponsors of these protocols to ensure that that type of activity and that type of compliance activity, is started and is implemented.
Thank you. How will the SEC's recent guidance on stablecoins impact VASP due diligence?
Yeah, that's an interesting question. We don't know exactly what the SEC is going to do yet. That's the truth of it. They've sort of asserted this regulatory authority over the stablecoin market, and what a lot of people have suggested is that might mean that we're going to see money market style, account style regulations imposed on the virtual asset sector. That's entirely possible, but the OCC has also come out and said that they're not giving up their regulatory authority over the stablecoin market yet either. So there might be some regulatory competition that comes into play here. We're expecting that there will be some type of securities market style regulation implemented on stablecoins in the future. Exactly what the shape of that is still yet to be determined.
Thank you. And how are VASPs AML regulated within the US and also globally?
Sure. So within the US, they're money services businesses. They have to register with FinCEN. They have to implement an AML program, which is great because it allows for lots of information sharing. It allows for sort of requests related to policies and procedures to be taken seriously because there's a regulatory mandate that you have such procedures in place. Outside of the US, there's sort of this cornucopia of regulatory approaches. There are certain jurisdictions that have sort of held themselves out to be very innovation friendly and sort of promote themselves as regulatory sandboxes. So the Seychelles is a very notable one where we're seeing a ton of crypto activity, but where regulation is still catching up to innovation to some degree. In other jurisdictions, we're seeing extremely tight control. So Ecuador, China, which we've already mentioned, have outright prohibited or have imposed extreme limitations on virtual assets and virtual asset service providers. So there's a hodgepodge of different regulations globally, but the US model of requiring registration and AML program implementation should serve as sort of a standard model for the rest of the world.
Thank you. And I think you touched on this one earlier, but can you elaborate on how the VASP definition applies to crypto mining companies?
Yeah, so crypto mining companies are virtual asset service providers. Typically, it's somewhat of a large caveat, but yeah. So if you are operating a mining entity, then by definition you are facilitating transactions between crypto and crypto, and you're arguably, and this is where it gets into a bit of debate over the exact applicability of the regulatory standard, but you're arguably maintaining safeguard over those assets as well. There is an AML program implementation requirement that will likely apply. There are also entities in this industry, though, that fight back against this, and that would definitely disagree with my assertion here. I do believe, though, that it's unlikely that these entities will be able to make the argument that they should be unregulated successfully, particularly when you consider the sanctions concerns attendant to mining activity.
Thank you. And can you still work with privacy coins if you abide by the travel rule?
You can. So the privacy coins are not illegal. They're not prohibited by any sort of regulatory effort in the United States, anything like that. And there are travel rule solutions. Elliptic has several partnerships that we can certainly refer you to as well to address travel rule concerns that can allow that type of information to be passed. The risk with privacy coins isn't so much that you're not going to be able to comply with the travel rule, because if you're working through a centralized exchange, for instance, you're going to have KYC to your customer. You'll know all of that beneficiary and or originator, depending on what side of the transaction they are. You'll know that information already, but what you won't know is the history of how that coin was used. So maybe that privacy coin had previously been sent to a sanctioned individual, or had been part of a ransomware attack, something like that, had been part of a payment from a ransomware attack. You won't necessarily have that information, and that's where the financial crime risk is sort of most impactful, not necessarily on the travel rule side, because the organization should both have that information already.
Thank you. And I am aware that we are getting quite close to time, so I'll just pick a couple more, and then we've got quite a few technical questions, so I think we'll have to follow up with them afterwards, rather than going on a bit of a technical deep dive. But with the pending increase in regulation, do you expect the appetite for VASPs will decrease, or will the value of crypto decline?
I would say neither is my true belief, because look, I think regulation is a good thing. I stand by that. There are lots of folks in this industry who are worried about what regulation might bring. What I think it brings is normalization. And if you want to truly have a successful sub part of the financial sector, and you want this to become a mainstream asset class, then having that trust in sort of the organizations that underpin the industry is extremely important. And you're only going to get that through regulation and compliance.
Thank you. And then I think this will have to be our final question for today, but will central bank digital currencies compete against stablecoins and traditional cryptocurrencies?
I think, yes, they will compete against stablecoins. I would say it's less likely that they'll compete against traditional virtual assets, cryptocurrencies, because it's not too often that those assets are actually being used for payment intermediation right now, those traditional assets, whereas stablecoins are more likely to be anyhow. And it is possible that they will supplant them. What I would say is that I think it will be a different impact on algorithmic stablecoins versus asset-backed stablecoins. Algorithmic stablecoins sort of have a separate place within the marketplace. They don't rely on any type of fiat backing, et cetera. So I don't know that those will necessarily be displaced. I do think it will have a negative impact on the asset-backed stablecoin market.
Thank you. And thank you so much for today's session. Thank you for everyone that joined us. The questions that we were unable to get to today, we will be collating them within the team and getting back to you with them. There's quite a few similar questions in here. So yeah, we will get back to you on all of those. Thank you everyone for your time today, especially you there, Chris. If you have any questions, please send us them on our website, elliptic.co. If you wanted to talk more about the Discovery product, or you have any regulatory questions or any questions in general, all of our team would be very happy to talk with you. So thanks everyone for your time today, and have a wonderful end of year, and hopefully see you in 2022. Thank you.
Thank you.